Welcome back to the deep dive. If I were to ask you to close your eyes and, picture a chartered accountant, what image pops into your head? Be honest.
Let me guess.
You're probably picturing someone maybe in a gray suit, sitting in a windowless room, just buried under this mountain of tax returns, stressing out about some deadline in April.
That is the classic stereotype, absolutely. The
Mm,
person who, tells you what you can't deduct and just make sure all the math adds up. The number cruncher.
exactly, the number. But today, we are going to completely shatter that image. We're taking that gray suit and we're trading it for a trench coat.
Okay, I like where this is going.
We are looking at the CA not as a compliance officer, not as a tax filer, but as a specialized investigator, a financial detective.
Hmm.
We're talking about fraud, hidden assets, corporate espionage, and the really high-stakes world of forensic investigation.
It is a completely different beast. It really is. We're moving from the world of, let's say, safety and compliance
Right.
into the world of risk and discovery. It's less about balancing the books and much more about finding out who cooked them.
And to guide us through this whole transformation, we have a pretty serious stack of documents to get through today.
We do.
We're pulling from these technical chapters on due diligence, investigation and forensic accounting, digital auditing, general auditing principles, and of course, professional ethics.
And the mission for this deep dive is really to unpack that transition. How does a professional move from being an auditor who is, essentially a watchdog
Yeah.
to an investigator who is more of a bloodhound? We're going to look at all the different types of investigations, from the routine business checks all the way to the high-stakes forensic cases, and we're going to see how things like AI and the Internet of Things are just completely rewriting the rule book.
I love that distinction you just made. Watchdog versus bloodhound. It really feels like the core tension of this entire discussion. So let's unpack that right at the start.
Let's do it.
To the untrained eye, if I see a person looking at a spreadsheet, they're just looking at a spreadsheet. What is the fundamental difference between a standard audit and an investigation?
It does look similar on the surface, I'll give you that, but the psychological shift is just massive. Let's start with the audit.
Okay.
An audit is a general examination. The only goal really, is to express an opinion. The auditor is asking one question. Are these financial statements true and fair?
Right. True and fair. That's the legal standard. It's about reasonable assurance.
Exactly. It is reasonable assurance, and that's the key word. It is not absolute assurance.
Yeah.
In an audit, you operate with what we call professional skepticism.
So you're alert. You're questioning things.
You're questioning, but you generally start with the assumption that the figures in the books are correct unless you find evidence to the contrary. You aren't, assuming everyone's a criminal from day one.
So it's kind of like a doctor doing a yearly physical. They check your vitals. They listen to your heart. They aren't assuming you have some rare tropical disease unless they see a blazing red flag.
That is a perfect analogy. Actually, there's a famous legal case mentioned in our sources, Short and Compton v. Brackert. It's from 1904.
1904. Wow, we are going way back.
We are, but the principles really stand the test of time. That case established that an accountant, when making an investigation for, say, an incoming partner, was entitled to assume that the figures appearing in the books were correct.
So the court basically said you don't have to approach the job thinking everyone's a liar.
Pretty much. That's the auditor, the watchdog. You bark if you see a burglar, but otherwise you kind of stay on the porch.
Okay, so that's the baseline, the watchdog. Now, flip the switch. What happens when we move to an investigation?
An investigation is different. It's not a general checkup. It is a systematic, really in-depth inquiry to establish a specific fact
A specific fact.
or to evaluate a very specific situation.
So instead of, is this broadly okay? It's, did this specific person steal this specific money? Or is this business actually worth what they say it is?
Exactly. The whole mindset shifts from professional skepticism to an investigative mentality. In an investigation, you don't just accept the books. You dig deeper, much deeper.
You can't just take their word for it.
No way! You require extensive corroboration. You're looking for the hidden truth, not just the presented surface.
So the assumption of health is gone. You are the specialist surgeon who's been called in because the patient is, like, coughing up blood.
Precisely. You are there to find the pathology. And sitting right next to investigation is another term we hear thrown around in every corporate drama and boardroom meeting. Due diligence.
Yes, due diligence. It sounds so formal, so corporate. We must do our due diligence. But what does it actually mean in this context?
Simply put, it just means taking care. The source defines it as a measure of prudence that any reasonable person should take before entering into a transaction.
So it's not just for CAs.
Not at all. If you're buying a used car, you kick the tires, you check the service history, you look under the hood, that is due diligence. You're just being careful.
So in the business world, this is the deep dive you do before you sign the contract.
Correct. And for a CA, it's a full 360-degree view. We aren't just looking at the bank account. We're looking at finance, tax, legal issues, marketing, technology, everything.
The whole shebang.
The whole shebang. You want to know exactly what you're walking into.
So, okay, we've got the foundation.
Mm-hmm.
Audit is the watchdog, ensuring general health.
Mm-hmm.
Investigation is the bloodhound, hunting for a specific truth.
Yep.
And due diligence is checking your parachute before you jump out of the plane.
That is a great way to put it.
Now, looking at our sources, they seem to break down these investigations into two really big buckets. And this feels like a crucial distinction for anyone trying to get their head around this field. We have statutory and non-statutory investigations.
Right, or as I like to call them, the must-do and the want-to-do.
Let's start with the must-do, the statutory side. This is when the government gets involved, right? This is serious.
Statutory basically means because the law says so. These are the investigations mandated by government regulations, specifically the Companies Act 2013 in our context.
So it's not voluntary.
Oh no, this is the government knocking on the door, and they usually aren't smiling.
What triggers something like that? Does the government just randomly pick companies to investigate?
Rarely. It's usually triggered by a smell of rot. The act gives the central government the power to order an investigation into the affairs of a company. Our sources highlight a few key sections here that listeners should probably know about. These are the heavy hitters.
Okay, walk us through them. What are they?
First up, there's Section 210. This is the broad power, an investigation into the affairs of a company by an inspector ordered by the central government.
And when does that happen?
It usually happens when things just seem fishy, mismanagement, oppression of shareholders, or maybe if the registrar of companies reports some kind of compliance failure.
Okay, so Section 210 is the government basically stepping in to say, hang on, we need to see what's going on in there.
Exactly. Then you have Section 212. Now, this is the big one. This triggers an investigation by the SFIO.
SFIO.
The Serious Fraud Investigation Office.
I mean, it's right there in the name. Serious fraud. That sounds like you do not want them showing up in your lobby.
You definitely do not. Section 212 is for the really complex, high-stakes fraud cases. These are the guys who come in when there's a suspicion of a massive systematic breakdown or, clear criminal intent.
So it's above the level of regular inspectors.
Way above. It takes the investigation out of the hands of regular police and hands it to a specialized multidisciplinary team. We're talking accountants, lawyers, forensic experts, all working together.
Okay. And what about when you want to know who is actually running the show? I saw Section 216 mentioned in the source material about ownership.
Yes, Section 216, this is the investigation of the ownership of a company.
But isn't ownership public record? I mean, can't I just look at the shareholder list?
You would think so, but in the corporate world, especially when people are trying to hide things, you have layers upon layers. Shell companies, proxies, nominees.
A complicated web.
A very complicated web. You might see a name on the shareholder list, John Doe, but John Doe is just a driver for the real owner. He has no idea what's going on.
The classic proxy setup.
Exactly. The government uses Section 216 to find out who is really pulling the strings, the beneficial owner. It's all about piercing the corporate veil to see who the puppet master actually is.
Investigating the shadow directors. That is very cinematic.
It is. And finally, we have Section 213, which is kind of a catch-all. It covers other miscellaneous cases where an investigation might be ordered, often triggered by an application from shareholders who feel the business is being conducted with an intent to defraud creditors.
So that's the statutory side. That's the you have to do this because you might be in big trouble side.
Yeah.
But I imagine the bulk of a CA's investigative work, day to day, comes from the other bucket, the non-statutory side.
Oh, absolutely.
The business needs side.
Absolutely. This is the commercial reality. This is where a client hires a CA as a kind of private eye for business logic. They aren't in trouble with the law, not yet anyway, but they have a problem they need to solve or an opportunity they need to vet.
What are the main scenarios here? Because the list in the source material was pretty extensive. It felt like it covered almost everything.
It covers the entire life cycle of a business, really. You have investigations on behalf of an incoming partner, Someone wants to join a firm and needs to know it's solid.
Makes sense.
You have valuation of shares in private companies. You have investigations on behalf of a bank proposing to give a loan.
Of course. If I'm a bank, I want to know if you can actually pay me back.
Precisely. Then you have investigations of suspected frauds. These are the internal investigations where the company wants to clean its own house before anyone else finds out.
Right.
And of course, the big one, investigations on behalf of someone proposing to buy a business.
Okay, I want to deep dive into that one first scenario A. Buying a business. Because I think that's where the detective skills really have to shine. You're looking for all the skeletons in the closet before you hand over millions of dollars.
This is the classic scenario. Let's say you want to buy a company. You hire a CA. The very first question the CA should ask, according to our sources, is deceptively simple.
What is it?
Why are they selling?
It seems so obvious, but it's so loaded, isn't it? If this business is such a goldmine, why are you giving it to me?
Exactly. Is the current owner retiring?
Yeah.
Okay, that's fair enough. Is there a health issue? Understandable. But is the industry dying? Is there a new regulation coming down the pipe that's going to kill the business model?
Or is the business just entirely dependent on the current owner?
That is a huge red flag mentioned in Chapter 17. Think about a consultancy or a PR firm. If the turnover depends entirely on the personal relationships or the specific personality of the departing partner,
That goodwill just walks out the door the moment they hand over the keys.
the moment they sign the check, you're buying an empty shell. The clients were there for Bob, not for the company. If Bob leaves, the clients leave too.
So the investigator has to figure out if the profit is attached to the system or to the person.
Exactly. That's the core of it. Is it sustainable without them?
The sources also mention checking things like leases and patents, which again sounds kind of boring and administrative, but I can see how it would be critical.
Oh, it's make or break. Imagine buying a successful restaurant and then finding out the lease on the building expires in 6 months.
And it can't be renewed.
And cannot be renewed. You've just bought a kitchen, you
Yeah.
have to move, you lose the location, the foot traffic, everything. It's worthless.
Or a tech company.
A tech company where the key patent expires next year.
And suddenly your secret sauce isn't secret anymore? Everyone can copy your product legally.
The investigator has to look at the unexpired period of these things. It's all about future viability. You are buying the future cash flows, not the past glory.
Now, here is where it gets really interesting to me, what the source called accounting gymnastics. I feel like this is where the CA really has to be sharp. How do companies, dress up the bride before the wedding?
Oh, there are so many tricks. We call it window dressing. The investigator looks for subtle changes in accounting policies right before the sale.
Like what? Give me an example.
For example, did they suddenly change how they recognize revenue just this year to make profits look higher?
So they're boosting the numbers right before the sale, like booking a 3-year contract as one big chunk of revenue in the first year.
Exactly. It creates this massive spike in profit today, but it completely robs the future. The buyer thinks they're buying this amazing high-growth company, but the revenue has already been eaten.
That is so devious.
It is. Or look at unrecorded liabilities. Are there lawsuits pending that aren't on the books? Are there huge warranty claims that haven't been accounted for? The source mentions assessing these contingent liabilities.
You don't want to buy a company and then inherit a massive lawsuit the next day.
It's like buying a house and finding out the foundation is completely cracked, but they just put a nice new rug over it.
And painted the walls fresh yesterday.
The investigator's job is to lift that rug and scratch the paint.
Okay, so that's buying a business. Let's shift gears to scenario B. The bank's perspective. I'm a bank. You want a massive loan. I send in my investigator. Obviously, I want to know if you can pay me back. But the source material mentioned a specific regulatory trap here regarding something called NBFCs. What is that all about?
This is a really crucial check in the Indian context. NBFC stands for non-banking financial company.
Okay.
Think of them as shadow banks. They lend money, they buy stocks, but they aren't full-fledged banks.
Got it.
The Reserve Bank of India, the RBI, is very strict about who can be an NBFC. You need to be registered. But sometimes a regular manufacturing company starts, dabbling in the market.
They get a bit too clever with their spare cash.
Exactly. They start lending money to sister concerns. They start buying heavy amounts of stock with their surplus cash.
So they kind of drift into banking territory without even realizing it.
Precisely. And the investigator has to run what the source calls the 50-50 test.
Okay, let's unpack the 50-50 test. What's the math?
It's a dual test. It's 2 questions. First, are the company's financial assets, things like loans given, shares, bonds, are they more than 50% of its total assets?
Okay, part 1.
And second, is the income from those financial assets. So interest, dividends, is that more than 50% of its gross income?
So if you're mostly holding stocks and bonds, and you're mostly making money off interest, even if your sign says Bob's Burgers, you aren't a burger shop anymore. You're a bank.
Basically, yes. And if you are, you need registration with the RBI. If you don't have it, that's a massive regulatory risk. If I'm the bank lending to you, I can't lend to an illegal operation. The investigator has to catch that.
Got it. But beyond the regulations, the bank just wants to know if the business is going to survive.
Yeah.
Is it a good bet?
Correct. And this brings us to threat assessment from Chapter 2. The investigator looks for threats to financial stability. Is there high competition with margins that are just getting squeezed thinner and thinner?
Right.
Is there rapid technological change making their product obsolete?
Product obsolescence is a huge one. You don't want to lend money to a pager factory in 2005.
Or a DVD rental chain in 2012? The numbers might look great today, but the technology curve is about to absolutely kill them. The investigator has to look out the window, not just at the ledger.
And there's another really important concept mentioned here called substance over form.
Substance over form. I love this phrase. It sounds so philosophical.
It does. It sounds like something Plato would say about accounting.
It is the philosopher's stone of auditing and investigation. It means looking at the economic reality of a transaction, not just its legal label.
Give us a concrete example of form versus substance.
Okay. Let's say Company A sells a piece of machinery to Company B for $1 million. Then immediately, Company A leases that exact same machine back from Company B.
Okay, so on paper, the form is a sale. Company A has revenue of $1 million.
Correct. It looks like a great sales quarter. But the substance is that Company A just borrowed money using the machine as collateral. They still have a machine, they still use it every day. It's a loan, not a sale.
And if you book it as sales revenue, you are basically lying about your performance.
You're completely misrepresenting the health of the company. The investigator has to strip away that legal label to see the economic truth underneath.
And the source listed some red flags for this.
Yes. Highly complex transactions, especially ones that are happening right at the end of the year.
The last-minute deals.
Always suspicious. Operations in tax havens. Or using intermediaries, middlemen with no clear business justification.
So if I'm selling goods to a company in the Cayman Islands, and then that company sells them back to another one of my companies, the form is sales, but the substance is probably money laundering or tax evasion.
Precisely. If a transaction is complex for no apparent reason, that's a huge warning sign. Complexity is often used to hide things.
Which leads us perfectly into Scenario C fraud investigation. This is the crime scene.
This is where the CA is definitely the bloodhound. When we talk about fraud, we have to distinguish it from error. An error is a mistake. I typed 100 instead of 1,000. Oops.
Right, an honest mistake.
But fraud implies intent. Intent to deceive.
But how do you prove intent? You can't actually read minds.
You look for patterns. Chapter 10 mentions the types of inquiries regarding suspected fraud. The investigator has to manage any conflicts of interest and, again, apply that investigative mentality. They are looking for patterns.
So one error is a mistake.
But 10 errors that always happen to favor the manager's bonus calculation. That's not a mistake. That's a pattern. That is evidence of intent.
So we know the different types of investigations, but how do they actually do it? Is there a checklist? A standard recipe, like there is for baking a cake?
And that is the tricky part. For an audit, there are international standards on auditing. It's a fairly standardized recipe.
Right, you follow the steps.
But for an investigation, there's no standard recipe.
Really? It's just freestyle.
It has to be. Chapter 17 is very clear on this. It depends entirely on the client's goal. If you hire me to check for payroll fraud, I'm not going to waste time looking at your inventory. The scope is defined by the instruction.
So walk us through the process steps that are mentioned in the source. How does it start?
Step 1 is the instructions. This is absolutely crucial. You have to define the objective and the scope very clearly with the client. What exactly do you want to know? Find out where the money went is a perfectly valid instruction.
Okay, so you have your mission.
Step 2 is the program. Based on those instructions and the nature of the business, its structure, you formulate a plan. You design the attack.
And then step 3 is execution.
The actual digging.
That digging part must be incredibly difficult if the records aren't good. The source mentions the information gap.
This is a major, major challenge. The source distinguishes between investigations where you have complete records,
The dream scenario.
and those with little information.
Little information sounds like a complete nightmare. Here's a shoebox full of receipts and a smile. Good luck.
Or sometimes it's just the published accounts and some statistical data. In those cases, the methodology has to get really creative. You need independent verification.
How do you even do that?
Well, if the books say, Mr. Smith owes us $10,000, you don't just trust the books. You call Mr. Smith. You get a direct confirmation from him.
You go directly to the source.
You physically inspect the assets. If the books say there are 500 laptops in the warehouse, you go to the warehouse and you count them, one by one.
And checking trends, right?
Mm-hmm.
The source mentioned analyzing marketing strategies in order books.
Yes, absolutely. Does the company's pricing policy actually match the market? Are their order books really full, or are they filled with phantom orders to make the company look good? You have to corroborate the internal data with the external reality.
Like what?
Well, if the company claims its sales are doubling, but you see their shipping costs have stayed totally flat, something is wrong. You can't ship twice the product for the same shipping cost.
That's the detective work. It's connecting the dots that don't seem related.
Exactly. It's finding the inconsistencies.
This brings us to a term that has become very popular lately, and it sounds very CSI, forensic accounting. Is this just a fancy word for investigation, or is it something more specific?
It is specific. The word forensic literally means suitable for use in the court of law.
Ah, so the end game isn't just a report for the CEO to read? The end game is evidence for a judge and jury.
Exactly. Forensic accounting is the integration of accounting, auditing, and investigative skills. And the bar is just so much higher because whatever you find, it has to hold up under cross-examination in court.
We talked about the mindset shift earlier. The source contrasts professional skepticism with investigative mentality again here.
And it's worth reiterating because it's so important. An auditor asks, is this material? Meaning, is this mistake big enough to actually matter for the total profit? If a company turns over $1 billion, a $500 mistake is a rounding error. It's not material.
Right, who cares?
But a forensic accountant, they will focus on those seemingly immaterial transactions.
Why? Why sweat the small stuff?
Because fraud often starts small. Or it's deliberately broken down into small chunks to avoid detection. A $1,000 withdrawal might not matter in a $1 billion audit, but if it's happening every single day to the same specific offshore account,
That's the smoking gun.
that is salami slicing, taking tiny, thin slices so no one notices.
So the forensic accountant is looking for the needle in the haystack, but they're also kind of assuming the needle was hidden there on purpose.
And they require that extensive corroboration we talked about. One piece of paper is never enough. You need the invoice, the shipping document, the bank transfer, and the email approving it. You need the complete chain of evidence.
What kind of services fall under this forensic umbrella? I imagine it's more than just catching embezzlement.
Oh, it's very broad. Asset tracing is a big one, finding diverted funds. If a partner runs off with company money, they don't usually put it in a savings account under their own name.
No, that would be too easy.
They move it through a maze of shell companies, crypto, real estate. The forensic accountant has to follow that trail.
Following the money.
Anti-money laundering, or AML, is huge. Then there are insurance claims. For example, assessing claims under a PLI policy.
What's a PLI policy?
It could be professional liability insurance or product liability insurance. Let's say a company claims they lost millions of dollars worth of inventory in a warehouse fire. The insurance company hires a forensic accountant to verify that loss.
To make sure it's a legitimate claim.
Was it really millions? Or was the inventory already damaged? Or, and this happens, did they move the good stock out the back door just before the fire started?
Insurance fraud is a classic. And this source also mentions the IBC, the Insolvency and Bankruptcy Code.
Yes, investigating suspicious transactions under the IBC. When a company goes bankrupt, there's often a suspicion that assets were siphoned off right before the collapse. We call these preferential transactions or undervalued transactions.
Like selling the company car to the director's wife for $100.
Exactly that. The forensic accountant digs into that and tries to claw that money or that asset back for the creditors.
And increasingly, this has to involve digital forensics, recovering deleted data.
We can't ignore the digital side. It's everything now. Recovering data to prove embezzlement is standard practice.
Yeah.
Which brings us to a massive section of our source material, the digital environment.
This is where the detective needs to be a bit of a tech wizard. Chapter 12 goes really deep into this. It's not just paper trails anymore. It's all digital footprints.
It is, and the sources bring up some really futuristic examples that are actually happening right now. Let's talk about the IoT, the Internet of Things.
The smart devices.
Right. The source uses the example of a smart oven scanning QR codes to cook food, or a refrigerator that automatically orders eggs when you run low.
Okay, I love my smart fridge, but why on earth does an auditor care about my egg consumption?
Because that data, customer behavior, preferences, usage rates, that is all audit evidence. If a food company claims they sold 10 million units of a frozen meal,
The auditor can check the data from the ovens.
potentially yes. They can access the IoT data to see if those meals were actually scanned and cooked. It validates the revenue.
That is mind-blowing. The fridge is a witness.
The fridge is a witness.
Okay.
And think about heavy industry. Sensors on manufacturing equipment can predict breakdowns. If the IoT data says a machine is vibrating dangerously and is about to fail, you can't value it as good as new on the balance sheet.
You have to impair the asset based on the sensor data.
Exactly. Then we have AI and robotics. The source talks about RPA, robotic process automation.
Bots. Software robots doing all the boring, repetitive work.
They work 247 with 100% reliability in theory, but the source warns about operational risk.
What are the risks? What can go wrong?
Well, if you buy the wrong tool, or if you deploy the bots without a proper operating model, you can have a disaster on autopilot
You're just automating the mistake.
at incredible speed. Imagine you program a bot to pay invoices, but you forget to program a check for duplicate invoice numbers. That bot will happily pay the same fraudulent invoice 1,000 times in 1 second without blinking.
So the investigator needs to understand the code.
Or at least the logic governing the bot. They need to audit the algorithm itself, not just its output.
And then we have to talk about the buzzword of the decade, NFTs, non-fungible tokens.
Secured by the blockchain. The source notes that no one can copy-paste an NFT. It represents unique, verifiable ownership of a digital item.
For an investigator, this completely changes the definition of an asset.
It does. How do you verify the existence of a digital asset? You can't go count it in a warehouse. You check the blockchain. But then you also have to verify who owns the keys to that digital wallet. It creates this whole new layer of asset tracing. It's not checking the safe in the office anymore. It's checking the digital wallet.
Moving from the digital to the ethical and environmental, another huge shift mentioned in Chapter 18 is ESG assurance.
ESG, environmental, social, and governance. This is moving way beyond just profit. The sources highlight that investigations are shifting toward environmental and social impact. The question isn't just where is the cash, it's what is the impact?
The source mentioned something called Principle 6.
Yes, Principle 6, protection and restoration of the environment. The idea is that entities need to have policies to assess and rectify their environmental impacts. But companies lie about this all the time. We call it greenwashing.
Right. We are 100% sustainable. Look at our green logo.
And the investigator comes in and says, show me the data. If you claim you reduced emissions, show me the meter readings. Show me the supply chain audit. Show me the proof.
And the Institute of Chartered Accountants of India has actually issued social audit standards SAS 100 to 1600.
That sounds very official.
It is. These are new standards for the impact assessment of social enterprises. So if a company says, we improved literacy rates in 50 villages, a social auditor investigates that claim.
They actually go to the villages.
They go to the villages, check the records, talk to people, and verify the impact.
It's investigating the social profit, not just the financial profit.
Yeah.
It really broadens the scope of what truth means in a corporate context.
But with all this pressure investigating complex fraud, checking algorithms, verifying social impact, the human element becomes the weak link. We have to talk about ethics.
Chapter 19 covers this, and it is the absolute backbone of the profession. Without ethics, the investigator is just a hired gun. Their work is meaningless.
There was a specific anecdote in the source that I found really disturbing, the case of C.A. Angad. It's a real cautionary tale.
Yes. The digital signature disaster.
Tell us what happened there.
So C.A. Angad was asked by a client, this company Pitch Private Limited, to digitally sign a form. It was regarding the resignation of a director, a Mr. Ravi.
Okay. Sounds like a standard enough procedure.
It should have been. The company sent him the form, and they had just copy-pasted Mr. Ravi's signature onto the resignation letter that was attached.
Just a copy-paste, Jen.
Simple image file. C.A. Angad, knowing the client for a while, didn't think twice. He didn't verify if Mr. Ravi actually wanted to resign or if the letter was even genuine. He just digitally signed the form and uploaded it to the registrar of companies.
He just clicked sign and submit. He trusted the client blindly.
He failed to verify, and of course, it turns out the resignation was completely fake. The company was trying to illegally force the director out. C.A. Angered was held guilty of professional misconduct.
What's the lesson there for our listeners? It seems so obvious in hindsight.
The lesson is that digital signatures and remote work increase the need for verification, not decrease it. You can't see the person signing the paper in front of you. You have to be extra vigilant. Trust but verify is dead. The new rule is verify, then trust. You can never be a rubber stamp.
And the source also mentioned something called no clar.
No clair. Non-compliance with laws and regulations. The investigator must be alert to this. If they see a breach of law, environmental law, labor law, financial regulations, they have a duty. They can't just ignore it and say, that's not what I was hired to look for.
Not my job.
It is their job to be aware.
And finally, conflict of interest. This seems like a big one.
It's fundamental. The source is crystal clear. If threats, like intimidation from a client or being too familiar with them, cannot be eliminated, you must withdraw from the engagement. You cannot investigate your best friend. You cannot investigate a company where you own a massive chunk of stock.
Why not?
Because your independence is the only thing that gives the investigation value. If the market or a court thinks you are biased, your report is completely worthless.
So we've traveled a long way today. We started with the watchdog versus bloodhound. We went through the heavy hand of the statutory laws, the SFIO kicking down doors. We look at the commercial nuances of buying a business, checking for expiration dates on patents and spotting those fake revenues. We navigated the information gap in fraud cases, explored the high standards of forensic accounting for the courtroom, and then we looked at the future with IoT, bots, and ESG.
It is a really comprehensive landscape, and the key takeaway for me through all of it is the mindset, that investigative mentality.
It's about not taking things at face value. It's about questioning everything.
It is about questioning assumptions. It's about looking behind the curtain, or, looking behind the blockchain in today's world. Whether you are serving a client who wants to buy a business or serving a court that needs to jail a fraudster, the mission is always the same. Establish the fact. Uncover the truth.
And that brings us to our final thought for the day. We've seen how technology is now generating the evidence. The smart ovens are witnesses, the bots are processing the transactions.
Right. The data is everywhere.
So here's the question. In a world where AI and bots are processing all the transactions and smart devices are generating all the data, will the financial detective of the future need to be a coder first and an accountant second? As truth itself becomes more digital, just lines of code on a server, how does the very definition of evidence change for the forensic accountant?
That is the billion-dollar question, isn't it? Can you cross-examine an algorithm?
Something for all of us to mull over. Thanks for listening to this deep dive into the world of financial investigation. We'll catch you on the next one.
Goodbye.